money, right now, thousands of dollars every single tax year, because you don't fully understand the deductions available to you as a California landlord. Most of you are leaving $5,000 to $15,000 on the table annually. That's a new roof, a down payment on another unit, or just plain profit evaporating because you're either misinformed, lazy, or simply unaware. This isn't theoretical. This is cash out of your pocket. Let's start with the undisputed heavyweights: mortgage interest, depreciation, and repairs. These aren't suggestions. These are foundational deductions. Mortgage interest is straightforward. Every dollar of interest you pay on your rental property loan is deductible. For a $700,000 property with a $500,000 mortgage at 7% interest, you're looking at roughly $35,000 in interest payments in the first year alone. That's $35,000 directly reducing your taxable income. Don't gloss over this. Now, depreciation. This is where many of you stumble, and it's costing you dearly. Depreciation allows you to deduct the cost of the property over its useful life, excluding the land value. For residential rental property, this is 27.5 years. Let's say your California property is worth $700,000, and the land value is 20% of that, or $140,000. Your depreciable basis is $560,000. Divide that by 27.5 years and you get an annual deduction of approximately $20,363. Think about that, over $20,000 in non-cash deductions, year after year for a typical California rental. If your marginal tax rate is 30%, federal and state combined, that's over $6,000 in tax savings just from depreciation. For many of you with multiple units, this easily translates into $8,000 to $12,000 or more annually. Ignoring depreciation is financial malpractice. Finally, repairs. Not improvements, but repairs. Fixing a leaky faucet, patching a hole in the wall, replacing a broken window pane. These are immediately deductible expenses. If you spend $1,500 repairing a broken water heater, that $1,500 comes directly off your taxable income. The IRS defines a repair as restoring something to its original condition, while an improvement adds value or extends useful life. A new roof is generally an improvement, depreciated over time. Patching a small section of a roof is a repair. Understand the difference. It impacts when you get your money back. But wait, there's a catch. While federal deductions are critical, you operate in California. The good news: California generally conforms to federal tax law for most rental property deductions. This means the mortgage interest, depreciation, and repair deductions we just discussed apply equally at the state level. However, there are nuances. For instance, California doesn't conform to certain federal bonus depreciation rules or Section 179 expensing limits for real property. This means you can't always accelerate depreciation on certain improvements for state tax purposes the way you might federally. Don't assume identical treatment. Here's a California-specific deduction many landlords overlook: the state income tax deduction for business personal property. While federal Schedule E doesn't specifically call this out for rental properties, California's Franchise Tax Board, FTB, recognizes it. If you furnish your rental units, refrigerators, stoves, washing machines, dryers, these are considered business personal property. You can depreciate these items, often over a shorter useful life than the property itself, typically 5 to 7 years. If you spend $5,000 furnishing a unit, you could be looking at an additional $700 to $1,000 in depreciation deductions annually for those items alone. Are you tracking this? Most of you aren't. This is a clear example of how knowing California's specific rules puts more money in your pocket. Now here's where it gets interesting: your daily operations. You drive to your rentals, you use a part of your home, and you pay for expertise. All deductible. Travel expenses to and from your rental properties for management, maintenance, or showing the unit are deductible. This includes mileage at the IRS standard rate, which changes annually, but is currently around 67 cents per mile, parking fees and tolls. If you drive 50 miles a month to check on your properties, that's 600 miles a year. At 67 cents a mile, that's $402. Multiply that by several properties and you're easily at over $1,000 annually in deductible mileage. Don't just estimate. Log your miles. Your home office. If you use a portion of your home exclusively and regularly for your rental property business, not just occasionally, but as your principal place of business for landlord activities, you can deduct home office expenses. This isn't just for full-time business owners. If you manage your properties from a dedicated space, you qualify. You can deduct a portion of your utilities, insurance, depreciation on your home, and even rent if you're a renter. For a 200 square feet office in a 2,000 square feet home, you can deduct 10% of those costs. If your total home expenses are $30,000 annually, that's $3,000 in additional deductions. The simplified option is $5 per square foot, up to 300 square feet, which is $1,500. Don't be scared of the home office deduction. It's legitimate for active landlords. Professional services are also fully deductible. This includes your attorney fees for leases or evictions, your accountant for tax preparation, and any property management software subscriptions. If you pay a lawyer $1,000 to draft a new lease agreement, that's $1,000 off your taxable income. These aren't luxuries, they're business necessities, and they are fully deductible rental property tax deductions 2026. Many of you fall into the passive activity loss trap, costing you immediate tax benefits. Generally, rental activities are considered passive. This means you can only deduct passive losses against passive income. If your rental property generates a loss and you don't have other passive income, you can't use that loss to offset your W-2 income or other active business income. The losses are suspended and carried forward until you have passive income or sell the property. However, there are two critical exceptions. First, if you qualify as a real estate professional, which is difficult for most part-time landlords as it requires significant time commitment, your rental activities are not considered passive. Second, and more relevant for many of you, is the active participation exception. If you actively participate in your rental activity, you can deduct up to $25,000 of passive losses against non-passive income, such as your W-2 wages. This $25,000 allowance phases out for adjusted gross incomes, AGI, between $100,000 and $150,000. What does active participation mean? It means you're involved in management decisions, approving new tenants, deciding on rental terms, approving repairs, or hiring property managers. It doesn't require daily involvement. Simply owning the property and collecting rent isn't enough, but making management decisions is. Many of you are actively participating without realizing the tax implications. If your property generated a $10,000 loss this year, and your AGI is below $100,000, you can use that $10,000 to offset other income. If your marginal tax rate is 30%, that's $3,000 in immediate tax savings. Don't let your accountant automatically classify your losses as suspended without discussing your active participation. This is a critical point for independent landlords who self-manage. You can claim every landlord tax deduction California offers, but if you can't prove it, it's worthless. Your record keeping is your frontline defense against an audit. The IRS and FTB don't care about your intentions. They care about your documentation. First, separate your finances. A dedicated bank account and credit card for each rental property or for your rental business as a whole is non-negotiable. Commingling personal and business funds is a red flag. When an auditor sees personal groceries and business expenses on the same statement, they immediately question everything. A dedicated bank account is your best audit defense. It simplifies tracking, categorizes expenses automatically, and presents a clear financial picture. Second, digitalize everything. Receipts, invoices, contracts, lease agreements, mileage logs. Scan them, save them to cloud storage, and back them up. Don't rely on shoeboxes full of faded paper. Use accounting software like QuickBooks or even a simple spreadsheet for categorization. For every expense, you need proof of payment, proof of purpose, and proof of amount. Did you buy a new water heater? Keep the receipt, the installation invoice, and a note about which property it went to. Third, maintain mileage logs. A simple app on your phone or a notebook in your car detailing date, destination, purpose, and mileage is sufficient. Don't guess. The IRS is notoriously strict on mileage logs. Without them, your travel deductions are vulnerable. If you spend $500 on supplies for a rental and you have the receipt, that's solid. If you claim $500 in mileage without a log, that's an immediate target for disallowance. Your diligence here directly translates to dollars saved. Recap. To recap, you are leaving substantial money on the table if you're not maximizing your rental property tax deductions. Depreciation, often overlooked. saves you $8,000 to $12,000 annually on a typical California rental. California generally conforms to federal rules, but specific deductions like business personal property depreciation are often missed. Actively participating in your rental business can unlock up to $25,000 in passive loss deductions against other income if your AGI is under $100,000. And finally, your best audit defense is meticulous record keeping. Separate bank accounts, digital receipts, and detailed logs. Stop losing money. Start claiming what's yours, powered by LeaseBase Intelligence.